2-year versus 10-year Treasury yield spread reached 42 basis points on January 9th, marking its highest level in over 2.5 years and ending the longest yield curve inversion in history. Now, typically a yield curve inversion, where short-term yields exceed long-term yields, often signals an impending recession. Now, the subsequent return to positive territory traditionally occurs when the Federal Reserve aggressively cuts short-term rates to combat the economic weakness. However, this time appears to be fundamentally different. Rather than responding to economic distress, the Fed has acknowledged that persistent economic strength suggested that rates are simply normalizing toward the neutral level. Now, the current yield curve steepening seems to reflect growing inflation concerns driven by two key factors. One, the possibility of premature Fed rate cuts, and two, the potential policy shifts from a new administration that could stoke inflation through implementation of tariffs or tax reduction and deregulation that could boost aggregate demand without corresponding supply-side solutions. Now, on January 14th, the latest reading of PPI came out and called into question the persistent inflation narrative, coming in lower than expected. Now, oddly, that release had little effect on the yield curve as the market waits for the more comprehensive inflation readings of CPI on the 15th and then PCE on January 30th. Now, if a trader believes the yield curve could continue steepening, they could express that by buying the January micro 2-year versus 10-year Treasury yield spread at 0.43, with a target of the historical average of 0.90. Now, a stop for this trade can be placed below at 0.15. This trade can make $470 if the target is reached and risks $280 if you're stopped out at your level. Now, it's important to remember that this spread gives you two independent positions and stops will need to be monitored manually. Now, if a trader believes that the yield curve could flatten from here, they could express that by selling the January micro 2-year versus 10-year Treasury yield contract at 0.43 and targeting a move back to zero. Now, a stop for this trade can be placed above at 0.70. This trade can make $430 if the target is reached and risks $270 if you're stopped out of your level.